Right, this diagram is going to be looking at a diagram which shows the benefits for an economy of increased international trade. So we're going to be looking at the trade creation diagram. Okay, now what you're going to remember is that economies, if they want to stop trade or reduce the number of imports coming in, then they will use some kind of protectionism. The main example we tend to focus on is a tariff. This is basically a tax on imported goods and services which makes them more expensive. So if you make them more expensive, you lower the demand for them, and by making them more expensive, it might make domestic goods more popular because they're more competitively priced. Right, now before we draw this diagram, let's just think about something we looked at in microeconomics. So we've got the demand for a good or a service, and we've got the supply of a good or a service. And the market equilibrium price will be determined by the price mechanism. So the equilibrium will occur at P star Q star. And very quickly, demand is downward sloping. The obvious reason is the lower the price, the higher the demand. The higher the price, the lower the demand. Supply curve, upward sloping. The higher the price, the higher the supply, because in theory there's more profit to be had at higher prices than low prices. Now what you need to remember is from AS economics is that this green area here shows the area of consumer surplus. Okay, so this is basically where consumers are paying the market price of P star, but for this demand, for example, this demand all the way down to where demand meets supply, people are willing and able to pay a price above what they were buying it for. Okay, so it means that they're generating consumer surplus or free satisfaction. They're paying a price lower than what they were willing and able to pay. Beyond Q star, demand is now lower than the market equilibrium price. So basically this now means that people are not willing and able to pay the market price. So in effect, all consumer surplus is maximised where demand meets supply. This triangle here, this blue one, is the producer surplus. Okay, and the simple assumption here would be that when the market price of P star is above what firms are willing and able to supply, it basically means that firms are getting a price above what they were willing and able to offer it at. So they're getting a price higher than what they were willing and able to accept. So we call that producer surplus. Again, producer surplus will be maximised at demand meets supply. Okay, we go beyond that point, beyond Q star, and what firms are willing and able to sell a good for is above the market price, so they wouldn't want to sell. So consumer and producer surplus. So let's now think about trade creation. Right, now what we need to remember, again bringing in that microeconomics diagram, we've got price and we've got quantity. So we've got this upward sloping supply curve. And I want you to assume that's looking at the domestic supply of goods and services in the economy. This is what domestic firms are willing and able to supply for. And we've got the demand domestic, so the demand within the economy for goods and services. Now, if we had no international trade at all, then the market would operate at P1Q1. Okay, so it means that domestic demand is satisfied completely by domestic supply. But what we assume is that when we bring in international trade, maybe lower protectionist policies, for example, then people can access goods and services below the domestic prices. So what would happen is this. So if we had complete free trade, prices might get forced down to P2. Okay, look what that means now, that domestic demand would move all the way out to Q2, people are willing and able to buy a lot more of these goods and services because the price is now lower. But at P2, domestic supply is only at Q3. Okay, so what you can now see is the gap from Q3 to Q2 is the gap between domestic demand and domestic supply. In other words, people are willing and able to buy more than what domestic firms are willing and able to supply. And this would basically be the imports coming into the economy. So domestic supply would be from 0 all the way up to Q3. The gap from Q3 to Q2 would be the imports coming in. Right, okay, now let's just look at a more realistic example for a lot of economies. So again, what we have price and quantity, we have the domestic supply, and we have the domestic demand. Now, if I go back to the previous diagram, we'd argue that if we were to go all the way down to P2, it's wonderful for consumers. It's a bigger range of goods and services, low prices, more competition, but it's not very good for domestic producers. There's not many firms willing or able to sell at P2, so you get this big surge of imports coming into your economy, which could be quite bad for your balance of payments, so your current account, for example. So what many economies might do to protect domestic jobs and domestic firms, they might start off not at complete free trade. They might start off somewhere like this. Let's call it P tariff. Okay, so not going to go for complete free trade. Let's imagine free trade would be all the way down here. Right, so think about the green line then, the price with the tariff. So what we would have is domestic supply at Q1. Domestic demand would be all the way out here at Q2. So what you should now realise is the gap from Q1 to Q2 will be satisfied by imports coming into the economy. Okay. Now, if we were to introduce free trade, then what would happen is domestic supply would fall because price would be squeezed down. So we'd now have Q3 for domestic supply. Domestic demand now would expand all the way out to Q4. So what you would now hopefully realise is that imports have increased not just from Q1 to Q2, but now all the way from Q3 to Q4. Now what we're going to be thinking about now is what is the benefits for consumers of this happening? This is where we bring in this idea of consumer surplus. And for this, what I'm going to do is to number a few different boxes on here. Call that 1, 2, 3, 4, and we'll have 5, and we'll have 6. Okay, now what I would say is first of all that the big benefit to the consumer would be by taking away that tariff is that the area, price tariff, price free trade, all the way out to 3 and 5. So when you think about it, it would be 1, 2, 3, 4. That is the expansion in consumer surplus. So that is what consumers gain from free trade. So a big increase in consumer surplus because of the lower price levels in the economy. Domestic producers will be less happy. So when you think about the domestic supply, they will lose some producer surplus. So these guys will lose the area, price tariff, price free trade, 6, 1. So in other words, that, and that. Okay. Now the government also loses from free trade as well. The government used to allow imports 1 to 3 to come in. Okay, now with the tariff, they would have earned 1, 2, 3, 4 as revenue coming in. So 1, 2, 3, 4, so that box there. And again, that will be lost. So what we can do with this diagram, we can show the net gain for the economy of international trade. So what we would argue is that, okay, first of all, we'd have this huge area of consumer surplus gain. So that would be the P tariff, price-free trade, 3, 5, that huge box there. But then what you would argue is, well, what's the overall benefit for the economy of that? Well, consumers have gained, but producers have lost. So that's not really a gain for the economy. We're just transferring producer surplus into consumer surplus. This area here, again, is consumer surplus that society's gained, but that's also tax revenue that the government have lost. So them two kind of cancel each other out. So of the consumer surplus gains, the only one that's really going to be good for the economy is that triangle and that triangle. So these two triangles basically show the benefits to the society of the free trade. So think about that without them numbers on. Let's draw this a few times. So we've got the domestic supply and demand again. We've got the price tariff. And then we've got, let's put these on. So we've got Q1, Q2. So again, Q1 to Q2 will be the imports coming in. And then you've got your price FT, let's call that free trade. So Q3, Q4. So when you think about it then, the big gain for consumers is all of this. So if you're a consumer, you're loving it. That is your expansion in consumer surplus. But it doesn't mean that's the overall benefit for society, because, let's draw this again. So supply domestic, demand domestic. We have the price with the tariff. So domestic supply Q1, domestic demand Q2. We bring in the free trade. PFT, domestic supply falls to Q3, domestic demand all the way out to Q4. Producers, or domestic producers should I say, they will lose the area of producer surplus. And then you've got to think about the impact on the government that used to be able to tax these imports coming in. So again, we've got the domestic demand, we've got the domestic supply, we've got the price for the tariff, then we've got the Q1 and Q2. By bringing in the free trade, prices plummet, domestic supply falls, and domestic demand increases. Well, remember, Q1 to Q2 were the original imports coming in. And the price between what the free trade price would be all the way up to the tariff measures the tax revenue that the government used to get. So when you think about it, then we've gained the big green box in the first diagram, but we've lost that red one for the producers, and we've lost this red one for the government. So if I was sort of looking at positive and minuses from this, then good. We've got this growth in consumer surplus. We've got bad, because we've got lower producer surplus. We've also got bad, because we've got lower tax revenue for the government. So when you think about that big green box in the first diagram then, this one here is not really gain for society. We've just transferred producer surplus into consumer surplus. This one isn't here a big benefit for the society, because this is basically taking money off of the government and putting it in the pockets of consumers. So the only real overall net gain for society will be these two remaining green triangles.